Jose asked me this one. This deserves about an hour of an answer, but I'm going to give you the outlines of it right now. Early starter. Okay, so I want to trade the markets between 2 and 4 Eastern because I get off work at 1. So are you tired when you get off of work? Are you in the ideal state of mind to then put in 2 hours of effort? I'll be trading the 5-minute charts. Not unreasonable, because if he's only trading the last 2 hours, I'm going to say, are you really going to trade the last 30 minutes with the crazy volatility here that is different than all of the information that you got from the earlier segments? Are you really prepared to make the change of state of mind from these 90 minutes, which is a continuation of the morning trade, and then they're starting to unwind and position for the overnight, and then absolute madness into the boy? That is a significant emotional event. So are you really going to trade all 4 of those hours? You're going to trade, or 4 30-minute segments, or are you just going to trade 3 here? Can you, by the time you get home at 1, can you be in a zero state with all of your other obligations done by 2? You have 60 minutes to do all your prep and analysis and emotional mind state to be ready to trade for the next 90 minutes, and then whether or not you're going to trade the last 30 minutes. Can you do that? Are you going to scan all 500 stocks in the S&P to find the biggest percentage gap up or down? So what's more important for the movement of predicting movements that are tradable in the last 2 hours? Was it the size of the gap from yesterday's close to today's open? Is it the size of the gap, or from the open, was it the size of the move from the open to open plus 1, 2, 3, 4, 5, 6, 7, 8, 9 30-minute segments, open plus 4.5 hours? Which one of those is more important about predicting the size of the move that's tradable in the last 2 hours? I would argue that the reason we pay attention to the gap is because we want to be ready for the open for the potential of the biggest movers early. But you're already seeing 2/3 of the day. Maybe what you want to find is the biggest change percentage from the open or from yesterday's close. I think from the open. Which one has actually already made the big move? Is it likely that something that had a huge gap then got very, very quiet and then was going to wait until suddenly the last 2 hours to make the huge move that the big gap predicts? Or is it more likely that something that had a big gap but then didn't move just was a failure to move, and that the last 2 hours are just going to be normal? I think that's more probable, that what it did from open to time now, time 0, is a better predictor than the size of the gap. Just what's the plus or minus percent change so far? That's how I find them intraday all day, is I take my stack and I look at percent change from yesterday's close. So that includes the gap plus the price. I just look at the current price versus yesterday's close, because the current price is then going to end up becoming the close, and then the day over day difference is going to be from close to close. So my hypothesis is that the difference between the current price and yesterday's close is the best predictor of what was going to be the biggest mover of the day, and which is going to attract people's attention for the swing trade. So that's what I would probably look at. S&P 500 that has a volume of over 200. So what you're really not going to do is scan the S&P 500 according to that plan, but you're going to look at things that are in the S&P 500 plus greater than 2 million shares traded, Y, and price above 20. Probably because of liquidity. What if something was not in the S&P 500 but had 2 million shares traded and was more than 20? Are you going to rule those things out, or are you just going to focus on the biggest, fattest, most likely follow throughers? Okay. I will risk $10 per trade with the ultimate goal of keeping my stop loss less than $10. Okay, well, there's things in the S&P 500 that have a share price of $10. There's things in the S&P 500 that have a share price of $1,000. How meaningful is it to say I want to risk $10 per trade on something that costs $10 per share versus $1,000 per share? A movement of, if and I want my stop loss not greater than $10. So there's a difference between stock price, stop loss, volatility, and hypothesis. The difference between risk per trade and the stop loss side. What I'm going to teach you in foundations, like on the PSAR flip or on the RLFF, which looks at a difference between the current price as measured by the RL10 with a risk box to the bottom of the RL10 and expressing that as a return to fair value that's greater than 4-to-1. That's a hypothesis that this trade is in an opportunity state, which says there's a reason to believe that the anomaly of the sell-off is going to get corrected back to the long-term fair value, and that there's a 4-to-1 imbalance between reward and risk, which justifies taking the risk, and that I've seen enough favorable price action to suggest that that might actually be the bottom and that the reversion to the long-term fair value is occurring. If that's the hypothesis of the trade, I don't care how far this is from price to the failure price. Like, what if that was $20? Well, then this would have to be $80. As long as that ratio is 4-to-1, I don't mind having a $20 execution stop. So why does what's magic about a $10 execution stop? What matters is that the execution stop should reflect that the hypothesis of the trade has failed, and now you have evidence to believe that the upward move is not occurring. That's what we want in the execution stop. And I want a reasonable chance to see both the reward and that the size of that execution stop is manageable. The shorter your time frame, like, oh, by the way, the last 2 hours of the day, and if I'm using a tiny little risk box because this was manageable in here, but I'm expecting greater volatility, that's why I may have to set that equal to 0.6 so that I can have a buffer of 0.4 so that I never take greater than a 1-hour loss. That's fine. So what that means is I have to figure out what size the actual manageable risk box is. That's the MMRB, because I got to be able to see the signal, act on the signal, and still, with slippage, spillage, and the passage of time, not take greater than a 1-hour loss. Now, if that's my minimum manageable risk box, can I still see a reasonable two of those inside this 90-minute or hourly move? So that means that I got to pay attention to the low of the day and the high of the day, figure out where price is at this moment. And then from the low of the day, is there still reason to believe from here, if this is my range stat move, and if this is my risk box, I could then say, hey, it could still move back to the high of the day or to the range stat, and then compared to my minimum manageable risk box, I can still see 2-to-1. Okay, then I could take that trade within the expectations of volatility in that last 2 hours of the day. Now, $10 risk per trade has nothing to do, has absolutely nothing to do with the pattern that you are choosing to trade. That the only thing $10 per trade has to do with is what percentage of your portfolio does $10 of risk capital represent. If I'm trading $100,000 in my portfolio, a risk of $10 is 1/100th of a percentage. So I'm not putting the portfolio at risk, because if I take the 1 hour loss, I'm going to lose $10, and that's not going to put the seed capital at risk. I can afford just to let the system be the case. Don't confuse that with the cost of position. The cost of the position is that I've got, if I have to buy 30 shares of $100, I have to buy 300 shares of $100 stock, I got to spend $30K to buy. Can my trading capital buy the position? I'm not risking $30K unless I have a system where I cannot control the losses to 1R. See my earlier discussion. Don't confuse the cost of position with the dollars at risk per trade. Don't confuse the dollars at risk per trade with the size of the stop loss, which is geared towards the hypothesis of the trade that tells me that trade is not working. Hypothesis is over. 3 really important questions. So here's what I'm going to tell you to do. You are nowhere near ready to answer that question correctly for yourself, I think, until you've thought through some of those things. So your other questions were, what are my thoughts on this time frame? That's the hardest time frame you could possibly choose, given that you just worked a full day, 8 hours or 12 hours. You have 60 minutes to come home, decompress, get in the mindset, do all your thinking and all your prep, read the leaves, scan 500 symbols to pick how many are you going to consider with your span of control. 1, 5? It better be just one. Otherwise, you're going to be chasing all of that scramble and not even be focusing on effective performance. What I would tell you when you listen to all the lessons in the foundations is I would say something like, hey, before you make any decision on that, how about listening to the nightly podcast for 30 days? Look at my 3-minute sniper trades of the day, which looks very much like what you're doing here, or the 3-minute, 5-minute Aussie, or the Forex guys. Oh, by the way, Forex is great because now you're not locked into just trading for 2 hours. You got 18 hours to pick and choose. You're not under any time pressure. They have much less bar-to-bar volatility, and the trades unfold at normal times that are not constrained by the absolute madness of the closing 2 hours of the equity markets. That's what I would do. I'd take a strong look at what the guys are doing in the 5-minute Aussie, the 3-minute Aussie. And then you could look at the 3-minute, 5-minute, 10-minute on the Forex instead of trying to fit that in a 90-minute session. But you might take a look at the 3-minute, 5-minute, 10-minute on the stocks and decide if you can execute that. You should also study the Kata 2 challenge that the guys at Ableway Tech are doing. What I told them to do when they were first learning how to trade intraday in those constrained time frames was pick two symbols, an aggressive EWZ index and a conservative DIA. Don't scan anything. Become expert in a volatile index that moves all day and a conservative index that moves all day that can be traded with futures and with intraday movements and in the aftermarket in futures, and you're not constrained the way you are just with equities. And then you can learn how to trade these patterns and find which of these. Is it the SSC, the collapsing dragon, the Z3P, the Kata 2? Which of those is a pattern that you could use on one or the other or both to develop the proficiency over 300 trades in a month to decide which style works for you? And then you could decide if 3-minute, 5-minute, or 10-minute is appropriate. By understanding those, you can defer for a little while answering all the specific questions of the standard trade framing. So instead of trying to frame trades across 100 symbols and choose it, no, just keep it simple with standard patterns. Look at the Kata 2 challenge, look at EWZ and DIA, start practicing those, and practice those all day intraday with bar by bar trading, so that when you finally decide which bar by bar you're going to do, 3, 5, or 10, on which symbol you want to choose, EWZ or DIA, once you get proficient on those, you could begin to think about finding the things that had the biggest percent win or loss from yesterday's price as a way to say, well, that thing is probably going to have one more strong follow through all day. What you're doing there is you're looking for the extra volatility of those symbols instead of the predictable volatility of DIA or EWZ. But you got miles and miles to go on a long journey to answering these questions. And the foundations course over the next 10 weeks is the time to start taking those steps, making tentative plans, and doing like Hamada's doing. Started with a couple symbols, expanded the symbols, looking about changing time frames, adjusting position size, going to a 10-minute chart. He's exploring in a systematic way all the options he has to find out what style works best for him, as opposed for waiting for me to tell you one thing. I haven't seen anything about how you trade yet. So don't hurry that. Just do the bar by bar with forward trading, paper trading, but committing to the process and showing your stats. Now, how do you get the right stats? Get a hold of Griff Cooper to give you the stat sheet in Excel so that you can look at standard patterns expressed in the way they keep score, so you can put our standard statistical treatment on it. You'll see plenty of that over the next 2 weeks. The boys in this room can help you with that too, that are in foundations right now, because they better be doing it too. So that's what I want to say about this. So let me get this publishing process, complete the daily report, and I'll see you guys in about 15 minutes. Good questions, great work. There was a weekend worth of work in that 80 minutes.
Thanks for your wisdom, Ken.
Yeah,
like
so study
always.
these. Okay, got to run.